Welcome to this explainer. Okay, today we're tackling something pretty much everyone runs into when they finally decide to put their hard-earned money to work in the stock market. You know you want to invest. You know the S&P 500 is historically a fantastic place to start, but the second you open up your brokerage account, bam, you just hit this giant wall of confusing acronyms. VOO, SPY, IVV. I mean, they all look incredibly similar, and honestly, it's enough to make any beginner's head spin.
So, what's the million-dollar, or actually, let's call it the multi-thousand-dollar question? Which S&P 500 ETF should you actually pick? And look, this isn't just about picking your favorite ticker symbol because it sounds cool. As you'll see in a minute, these funds are definitely not identical. Choosing the wrong one could literally cost you thousands of dollars over a 20 or 30-year timeline. So, we've really got to get this right.
All right, let's dive into this. Section 1, the illusion of choice. Because at first glance, they really do seem identical.
When you pull up these three funds, you're hit with what I like to call the illusion of choice. And they seem the same for a very good reason. VOO, SPY, and IVV literally track the exact same index. They all hold the exact same 500 massive US companies. Now, because of this, most people do one of two things. They either just close their eyes, pick one at random, and hope for the best, or worse, they get so entirely paralyzed by the illusion of choice that they just close out of the app and never end up investing at all.
Moving on to Section 2. Let's officially meet the contenders and end this confusion once and for all.
Now, what's really interesting about this slide is the sheer, staggering scale of wealth here. These aren't some tiny boutique funds. We are talking trillions of dollars. First up, we've got SPY, launched by SPDR way back in 1993. It's the granddaddy of them all, the oldest S&P 500 ETF out there, managing about $550 billion, trading around $560 a share, with a fee of 0.0945%. Next is IVV, created by BlackRock in 2000. It manages $500 billion, also trades around $560 a share, but it has a tiny fee of 0.03%. And finally, VOO. Vanguard created this one in 2010, and despite being the newest kid on the block, it is an absolute giant. It manages an astonishing $1.1 trillion. It trades around $500 a share and, just like IVV, has that low 0.03% fee.
Which brings us nicely to Section 3, the expense ratio trap. It's time to get a bit serious and talk about hidden costs.
You probably noticed I kept mentioning that fee percentage a second ago. We're moving past the theory here and into the harsh reality of investing. In the finance world, this fee goes by a specific name, the expense ratio. It's basically the annual cut the fund takes just to manage your money and keep the lights on. And listen to me carefully here, because this expense ratio is absolutely the single biggest difference between these three options.
Let's set our baseline. Both Vanguard's VOO and BlackRock's IVV charge a ridiculously low 0.03% per year. To put that into perspective for you, that means for every $10,000 you have invested, they are charging you a grand total of $3 a year to manage it. $3, that is virtually nothing. But then we look at SPY. SPY charges 0.0945% per year. Now, I know exactly what you're thinking. Does that really matter? It still starts with a zero. Honestly, it sounds like a totally microscopic, insignificant difference, right?
So what does this tiny percentage actually mean in real, hard-earned money? Let's run a super realistic real-world math problem. Let's say you invest $10,000 today. You don't touch it. You literally just let it sit there for 30 years, and it grows at the historical average annual return of 10%. What happens?
And this brilliantly illustrates the massive impact of that microscopic fee difference. If you put that 10 grand into VOO or IVV with their 0.03% fee, after 30 years, you're sitting on $169,800. Not bad at all. But if you put that exact same 10 grand into SPY with its 0.0945% fee, you end up with $164,900. Same index, same 500 companies, radically different results. That is a gap of $4,900. That is literally almost $5 grand that just vanished from your account over a lifetime of investing, all because of a slightly higher fee. And remember, that gap only gets wider if you're investing more than $10,000 or if you're consistently adding money every single month. Fees matter so much more than most beginners realize.
Section 4. Traders versus long-term investors. So why does anyone still use SPY?
Seriously, at this point, you've got to be wondering why anyone on Earth would ever buy SPY if the fees are eating their returns. Well, here's the secret.
active day traders absolutely love SPY. Because it's so heavily traded, it has massive daily liquidity and the tightest bid-ask spread. That means it's super easy for a trader to jump in and out of the fund 20 times a day without losing pennies on every transaction. But you're a long-term investor. You're buying this to hold for 10, 20, or maybe 30 years, right? You're not day trading the S&P 500. So SPY's massive liquidity advantage literally means nothing for your portfolio. For us long-term folks, keeping fees low is the whole game.
Actually, wait, we also have to talk about something called dividend drag. All three of these ETFs pay out dividends from the companies they hold, but VO and IVV are structured to reinvest those dividends super efficiently. SPY, on the other hand, because it's stuck with his older legal structure from way back in 1993, it's actually forced to hold those dividends in a non-interest-bearing account before passing them on to you. That creates a drag on your overall returns. It sounds tiny for a single year, sure, but stretch that out over 3 decades of compounding and it absolutely takes a bite out of your wealth.
Real quick, before we get to our final verdict, I want to address one huge beginner fear: the actual share price. You might have seen earlier that these funds trade around $500 or $560 a share. Please don't let that scare you off. Fractional shares are a real game changer, and they're available for all three of these on pretty much any major brokerage today. You can literally hop onto an app like Fidelity right now and buy fractional shares of VOO to get started for just $1 single. The price tag on a full share doesn't matter anymore. You can start with whatever you have in your pocket right now.
All right, Section 5, the final verdict. Let's settle this dilemma once and for all.
We've looked at the data, we ran the math, and compared how they work under the hood. For a long-term beginner investor, VOO is the undeniable, absolute winner, and it takes the crown based on 4 pillars. First, it ties for the absolute lowest fee at 0.03%. Second, it's backed by Vanguard, which is arguably the most trusted name in the index investing world. Third, it's structurally the most tax-efficient for holding long-term. And fourth, if you somehow need any more convincing, Vanguard index funds are explicitly recommended by the legend himself, Warren Buffett.
Now, coming in at a very close second place is IVV. Honestly, it's a perfectly fine choice. It has that exact same rock-bottom 0.03% fee, and BlackRock is a massively reputable firm. If your specific brokerage app happens to favor it or gives you specific perks for buying IVV over VOO, you're still in phenomenal shape going with IVV.
So, the crucial takeaway here is this. If you are a long-term investor, you should just avoid SPY completely. Don't let its massive popularity fool you. Yes, it's a phenomenal tool for active day traders and huge financial institutions that need to move billions of dollars by lunch. But buying and holding SPY for a 30-year retirement strategy, you're quite literally throwing away thousands of dollars in fees and dividend drag.
The illusion of choice is officially broken. You've got the exact data you need now to protect your wealth from all those unnecessary fees. The only question left is entirely up to you. Knowing what you know right now, when you fire up your brokerage app tomorrow morning, are you Team VOO, SPY, or IVV? Take this knowledge, make your choice, and go let your money work for you. Thanks for hanging out with me for this